This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 429 was produced on May 23, 2024. I'm Eric Townsend. Dr. Anas Alhajji returns as this week's feature interview guest. We'll discuss the energy market's outlook for the second half of 2024, the Iranian president's death, fake news in Saudi Arabia, and much more.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, May 22nd, 2024. The S&P 500 June futures were down 9 basis points, trading at 53.28. It continues to press new highs. We'll take a closer look at that chart and the key technical levels to watch in the post-game segment. The U.S. dollar index up 60 basis points, trading at 24.91, bouncing off last week's lows, but too early to suggest a new breakout. July WTI crude oil down 135 basis points to 77.57. Distribution continues to weigh on the price action. We'll take a look at that chart in the postgame, and Eric will have the EIA inventory data. The July RBOB gasoline down 81 basis points to 246. The June gold contract down 4 basis points to 23.93. A fast 50% retracement in the advance in May, but will it be bought on dip? The copper down 142 basis points to 4.85, started a correction already 40 cents off its highs from earlier this week. Uranium up 71 basis points to 91.75, and the U.S. 10-year Treasury yield up 8 basis points, trading at 4.43. The key news to watch this Friday is the University of Michigan consumer sentiment, and next week we have the preliminary GDP, the pending home sales, and the core PCE price index. This week's feature interview guest is Dr. Anas Alhajji, founder of the Energy Outlook Advisors and recently named the third most influential voice in energy markets and social media. Eric's interview with Dr. Alhajji is coming up as MacroVoices continues right here at macrovoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Energy Outlook Advisors founder, Dr. Anas Alhajji. Anas, it's great to get you back on the show. There's so much going on in energy markets. Let's start by revisiting your calls from the past have been incredibly prescient. What you've told us in the past is basically, look, there's plenty of room for geopolitical friction in the system to cause price increases, but we're not headed back towards more than $100 a barrel until we get more demand, which you thought would be coming at some point in the future, and or we get a reduction in the amount of spare capacity that exists within OPEC. So let's start with an update and an outlook on where we stand for the second half of the year. Is that demand that you were looking for going to come back in the second half?
Absolutely. Based on our view has not changed for the year. We still predict an oil demand of, or a growth in the oil demand of 1.48 million barrels a day. But here is the problem that we have. If you look at the latest reports of the International Energy Agency, the IEA, and OPEC, you see very large differences. OPEC think that growth in 2024 in global oil demand will be 2.2 million barrels a day, but the IEA think it's only 1.1, so literally half. And when you look at those differences coming from the two largest organizations in the oil business, you start asking questions, what's going on? And as you know, and we talked about this before, we have major deterioration in the data quality since 2017. It got really worse with COVID, and then with the invasion of Ukraine, the gray fleet or the ghost ships, Russian, whether Iranian or the Venezuelan. So we have serious problems. But the biggest problem we have this year in addition to all the data deterioration, what we've seen is media reports and stories from the oil market are either fake news or they are tilted toward kind of supporting the Biden administration in the United States or the Modi administration in India in a way that we never seen before. Both of them are running for re-election. And you'll see a story, for example, without mentioning the names of the organizations, a story about India's imports from Russia. And all of a sudden, they try to show that the sanctions are working on Russia and the price cap is working and the government of Modi is cooperating with Europe and the United States. All of this is literally fake news. I can go on and on mentioning actual stories on this. But the idea here is with all the data problems, the data quality problems, with all the misreporting by the media, we should not be surprised that if OPEC and the IEA basically are added to the mix by giving us two completely different outlooks for demand in 2024. Our outlook is still the same, a 1.48 million barrels a day increase in 2024. The second half is usually better than the first half, but this is kind of a tamed growth no matter what. China did not deliver the expected growth. Most of the information about India, unfortunately, is absolutely not correct. The Indian growth is still weak. We still have some serious issues in the market when it comes to oil demand because, for example, you look at prices, we've seen the medium sour crude in Asia getting a premium over light, which is rarely for this to happen. But all of a sudden, it's been happening several times in 2024. And I think the media and many analysts missed the point about the medium sour. They missed the point because of the following. We have two new major refineries that have been commissioned, one in Kuwait and one in Oman. And both of them are designed to use medium sour, which means that all of a sudden we lost a very large amount of medium sour to those refineries, while the Asian refineries are starved because of this change. At the same time, Mexico reduced its exports of medium sour by 400,000 barrels a day since the beginning of the year. So it's really a refining issue by having a change in the market. And this is a permanent change, by the way, permanent change in the market, while the Asia refineries are still waiting for the medium sour to arrive. And that increased prices. Some people thought, oh, that's because of the increase in demand and therefore we have strong demand. It has nothing to do with demand. Literally, it is a change in the refining system, the global refining system, and that's why prices went up of medium sour crude.
So your expectation for the rest of 2024 is an increase over last year of 1.48, just about 1.5 million barrels per day by the end of 2024. What's the outlook look beyond then?
When it comes to 2025, we do have the outlook from OPEC and the IEA. They still have the same differences. The issue for 2025 basically is, and here is the funny part, even the IEA expect global oil demand to reach the highest ever in 2025, despite the fact that many people said oil demand has already peaked in 2019. So we have this retraction coming even from those who expected a peak that oil demand will continue to grow. And one of the problems we are facing right now is this retreat on global or on climate goals throughout the world. We have this major retreat, whether you talk about countries, you talk about policies, you talk about sectors, you talk about companies, and that major retreat means by default increase in demand for oil, gas, and coal. And the issue here is it's very hard to kind of get a handle on the impact of this retreat because we don't have experiences with this to look at previous data and see what a retreat like this will entail. So our problem right now is, what if this retreat is larger than expected? And does it mean that OPEC forecast of 22.2 million could be correct? Simply not because of growth in demand or regular growth in demand, as much as it is really a retreat in climate change policies that are increasing the demand. So the problem for 2025 is really not knowing the exact impact of this retreat.
Anas, let's move on to the situation developing in Iran. I should tell our listeners we're recording on Tuesday afternoon, a couple of days before they will hear this. As of this moment, it's obviously been well reported that the president of Iran was killed in a helicopter crash. As of this moment, we don't have any really definitive and certain answer as to whether any foul play was involved, but we certainly have not seen any conclusive evidence that it has been. It's only speculation that there might be some foul play involved. What does this mean? I guess in both scenarios, if it's foul play, if it's not foul play, what is the significance of this to the oil market, and to what extent is it important that we have this kind of unknown regime change? You know, who's going to be the next guy is not really clear yet. How much risk does that introduce into the system?
Oil was discovered in Iran in 1908. Since 1908 until today, no other country had an impact on the oil market more than Iran. The events that Iran went through throughout history, because it was a very large producer. At one point, they produced more than 6 million barrels a day. Whether you want to go through the occupation of the British and the Soviets of Iran, or the nationalization in 1951, or the coup in 1953, or if you want to go forward and look at what OPEC did before the oil embargo in 1973 when they increased the posted prices because the Shah was supporting that, or the labor strikes in 1977, 1978, and then the Iranian Revolution in 1979, then the Iraq-Iran war between 1980 and 1988, and then the nuclear program. We know the impact of all these events, etc. Then the agreement in 2014, then the Trump decision to end that agreement in the fourth quarter of 2018, and all the things that ensued after that. Or you want to talk about the Gaza war, the Houthi attacks, etc. So if you plot all those attacks over time, there is no country in the world had more influence on the oil market than Iran. So that's the history. But at the same time, if you look at what we saw, and I think we were the first one on Sunday to say that if the president and the foreign minister are dead, there will be no impact on the oil market. And some people got annoyed by it, especially the oil bulls who wanted prices to go up. And the reason why is this. The system in Iran is based on the Supreme Leader and the Islamic Revolutionary Guard. So there is a system. And the whole world, whether you talk about OPEC members or Iran's neighbors or the negotiations between the Europeans and the Americans, they are negotiating with a system. They are not negotiating with a person. So the president and the foreign minister are soldiers in a system. They serve that system. They advise that system. But if they disappear, that does not change anything, because the Supreme Leader and the Revolutionary Guard are everything. And therefore, we concluded from since Sunday that there will be no impact on the oil market. And if you look at oil prices, that's exactly what happened. Prices came back to what they were on Friday, and there were no change. So there is no impact, simply because it is assumed it is weather related. But to go back to the second part of your question, what if we discover it was not weather related? Everything changed from what I said. For example, it was suggested that Israel did that. Our view basically is Israel has no interest in killing the president and the foreign minister. No interest at all. But if it is the case, then everything changes, because that means the geopolitics impact on oil prices is going to increase substantially. We'll see reaction from the Houthis. We'll see reaction from Hezbollah. We'll see direct reaction from Iran itself in this case, and oil prices will go up. But the most likely scenario, if this is not weather related, is that it is a fight within the regime itself. So it is one faction against the other. And if that's the case, that would have an impact if those factions start fighting among each other, because that means resources will be diverted from the oil sector to other sectors. We may not see the same spending on upstream. Exports might be kind of affected because they are used to finance the regime. So which faction is going to control the oil revenues in this case? So the bottom line on this one is, if it is only weather related, our prediction was no impact, and still no impact on the oil industry, no impact on the oil sector. The Iranian oil company is still intact. The oil ministry is still intact. The foreign companies, especially the Chinese operating there, or the deals with the Chinese and others, even the negotiations with the United States are still intact. But if there is other things, then the situation will change. So we've got to wait to see whether new information comes up on whether this was just an accident or others involved to cause this accident.
Now, regardless of whether this was an accident or not, there's been a fair amount of speculation from people in the oil markets who have said, look, what's going on right now is Israel feels threatened by the Iranian nuclear threat, and there's a likelihood that Israel will mount an offensive preemptive strike to basically take out either the nuclear facilities or what might have been the nuclear facilities and so forth, in order to preempt any possibility of a nuclear strike from Iran against Israel. If that is to happen, or even if it starts to happen and there are rumors that it's happening, what are the consequences of that potentially?
Generally speaking, I personally do not think that's going to happen for multiple reasons. Let me back up here a little bit and mention the following issues. President Trump reimposed the sanctions on Iran in the fourth quarter of 2018. Candidate Biden in 2019 and 2020 promised that if he wins, he is going to bring the agreement back, the 2014 agreement back that President Trump rejected. So that was a campaign promise. And since day one, he tried, but the Iranians refused. Why they refused? Because they said, if our agreement with you is going to be tied to a president and the presidents change every 4 years, we are not going to invest in such a deal. So either the deal will be with the Congress or we got to renegotiate the deal. There is no way, based on the current circumstances, that the U.S. Congress will agree to a deal. But for President Biden, he got stuck. And I'm not defending Biden here. I think this is just kind of a apolitical view of the relationship between the Biden administration and the Iranian regime. President Biden wanted to come back to the agreement. So he wanted the Iranians to stay at the table negotiating in Vienna. The only way to keep them at the table is to ignore the sanctions. So he ignored the sanctions. But the Iranians are smart. They took advantage of the situation. They started increasing production and increasing exports. By August, September 2021, it was clear that the negotiations failed. And there it was a total failure. And we know now for sure it was a total failure. But at that time, the intelligence community knew, and I'm talking about August, September 2021, that Putin is going to go to Ukraine. And the plan was to go there in December. But the Chinese had the Olympics, and they were afraid that if Putin goes to Ukraine, he's going to ruin the Chinese Olympics. So they asked Putin to delay the invasion of Ukraine, and he delayed it until February 2022. But the U.S. administration knew he's going to go to Ukraine. They knew they are going to do something. They knew that they are going to impose sanctions on Russia. They predicted that with sanctions, Russian production will decline by 3 to 5 million barrels a day. Of course, that was a big mistake because we know that that's not going to happen, but I don't know who were their advisors who told them that. But they were expecting that. So they asked Saudi Arabia and its allies to increase production before they imposed the sanctions. And the Saudis and their allies refused. They refused for two reasons. The first reason is there were no shortages in the market when the Biden administration asked. So why increase production in a market with no shortage? The second thing is Russia is a member of OPEC Plus, and they viewed Biden's demand as breaking up OPEC Plus. So they rejected that. Here, the Iranians took advantage of the situation and they told the Biden administration, look, the Arabs basically are refusing to cooperate with you, but I have this floating storage, which was about probably 60 to 80 million barrels. If you let me sell it, I can liquidate that and help you out. But you got to kind of ignore the sanctions. And the Biden administration liked the idea. So the Biden administration started withdrawing oil from the US SPR. At the same time, the Iranians started liquidating their floating storage. And then because of this cooperation, the Biden administration, through a Gulf country, an Arab Gulf country, they give the green light to Iran, telling them, look, if you want to increase production and increase exports, I will ignore the sanctions as long as you send this oil to Europe. And Iranian oil was reaching Europe freely in front of everyone, despite the sanctions. So it started with Biden wanting to keeping the Iranians at the table for nuclear negotiations. By the time negotiations failed, the issue of Ukraine came up and the Biden administration wanted more oil in the market. So they kept, or in a sense, they just ignored the sanctions and they turned the blind eye to the sanctions. By the time the market stabilized and oil prices went back to the 80s, now we are in 2024 and Biden is running for re-election and he is afraid that oil prices will go up. So what is the solution is to ignore sanctions again. But we had the Gaza war, and then Israel hit the Iranian consulate in Damascus, and they killed some Revolutionary Guard members. So Iran retaliated by attacking Israel. This is a very important point here to mention, because our expectations were from the beginning of the year that if oil prices go up in the summer, the Biden administration will withdraw oil from the strategic petroleum reserves, the SPR. We were surprised when the Biden administration offered to buy oil for the SPR in August and September. That means we felt that they were really comfortable with the market and they were able to buy because they were thinking that prices will not go up. All of a sudden, out of nowhere, they decided to cancel those requests. And we learned later they canceled the requests a week before Iran's attack on Israel because they knew that Iran was going to attack and they did not know what the ramifications would be in the oil market. So they canceled the orders for August and September. That would allow them to withdraw oil from the SPR because you cannot fill and withdraw at the same time, technically. So right now, it's open for the Biden administration to use the SPR in August and September because they resumed purchases for October and November. Today, we learned that they are releasing gasoline from a certain reserve in the Northeast. So releasing gasoline give us a hint that they are willing to use the SPR if needed. Our view is that they will use the SPR if WTI reaches 90 or higher. As long as WTI is below 90, they will need to use the SPR. So we will see how this is going to go. So to sum up here, the cooperation between the Biden administration and the Iranians since day one is very clear. That first they wanted the Iranians to stay at the negotiating table, so they ignored sanctions. Then they needed the Iranian oil to cover for the Russian oil So they ignored the sanctions, and then because of the elections, they ignored the sanctions. But after Iran hit Israel, the Biden administration had to do something, so they reimposed some sanctions and new sanctions on Iran, including oil sanctions. And guess what? These are toothless sanctions. So the Iranian oil is still flowing, and the Biden administration is happy with that. So you look at all this indirect coordination, and it just energy politics at its best.
Now, as I try to interpret this big picture situation, the way I'm looking at it is it was very, very clear that Israel wanted to re-escalate the conflict with Iran after Iran's counterattack and so forth. The Biden administration put their foot down and said no. And frankly, I think it was not during an election year. You're not going to do that. It seems to me that it's likely after the election that the business between Israel and Iran is not over. I don't think either side is just going to forget what's happened. Would you agree with that? And if so, what would the potential consequences of a re-escalation between Iran and Israel be for the market?
You are absolutely correct on this scenario, and probably it is the most plausible scenario, as you stated it. The issue is, will the Israeli government survive? Because it's always living on the edge. It could collapse at any moment. So I think the scenario where there could be escalation depends on who is going to be in power after the U.S. elections, in Israel, of course. So will it be the same government, kind of a more leftist government, more lenient, more pro-Biden government? It depends. So I think everything hinges on what type of government Israel will have by early 2025.
Let's move on now to the Kingdom of Saudi Arabia, which has also been in the news, although not quite as much as Iran recently. There was an attempt on the Crown Prince's life. Well, the Crown Prince was not injured, but several of his guards were killed. I haven't really heard any clear reporting on who was behind it or what the motive was or what happened. And then the next bit of news to come out of the kingdom more recently, just in the last few days, has been that the Crown Prince was forced to cancel a trip because the king's health is not good, and there's a need for the royal family to stay at home while the king's health is questionable. So does this mean that the king's life may be coming to an end? And if so, what would the consequences of that be? How should we understand the situation overall? Who was behind this attempt on the prince's life? What does it mean? And how is this all going to develop from here?
I'm glad you mentioned that, because the first story about the attempt on the prince's life was fake news. And the video that being mentioned with that fake news is 2 years old and related to a fire in one of the streets in Riyadh. It's not related to any attack on him. And the first tweet that came out with the video has been deleted, but other people picked it up anyway. So although the original video and the original tweet was deleted because it was fake news, it carried a life on its own. So the news was absolutely not correct, and the video was 2 years old from a problem or a fire in one of the streets in Riyadh. As for the issue of succession, the first time I heard about issues of succession in Saudi Arabia and possible problems when I was still a master's student doing my master's, I heard about it at a conference and people raised it. And since then, this issue, because it just happened that most of the leaders in the Arab world in general and in the Gulf in particular, for a period of time, almost everyone was above 80. So there were this major concern by some about, okay, those are old people, they are going to die. Will you see infighting? Will you see problems? Will you see this? And for the last 30-something years, since I heard it the first time until now, we never had any problems. And many leaders died, and those who succeeded them died. And in some countries, even the third person died. And we did not have any problems. We did not see any problems in those countries. And this issue being raised again now because of the health and the age of King Salman. And it's the same old story. MBS is in total control. All the military experts and all the political experts will tell you the same. I've been hearing it all over. Jack Sullivan was in Riyadh a couple of days ago, while the media and others have been talking about deals that include nuclear reactors for civilian use to generate electricity, etc. Some people privately are suggesting it's probably related to the succession. We don't know. But the issue here is I've been monitoring Saudi Arabia for a very long time. And it is one of since I was a student, basically, I had to pick up 4 countries, 4 oil-producing countries to focus on. And Saudi Arabia was the main one, and it was a subject in my PhD dissertation, and I wrote hundreds of articles about Saudi Arabia. And I can tell you that I am not concerned at all about the succession and possible negative impact or some issues in the oil market. We've seen this so many times in the past, and nothing happened. And this is just going to be the same. So the first story is fake news. The second one is not a major concern. The issue that everyone, I think, should be concerned about is that those countries are going after renewable energy and hydrogen faster than Europe and the United States. So aside from politics, people do not realize that the Saudis and others may not need even to increase production capacity. All they get to do just focus on renewable energy to use less oil and gas, and then there will be more oil and gas available to the market without spending a single penny on expanding capacity. And I think this is a major issue in the next 10 years or so. And if you look at what they said today Saudi Arabia announced the lowest cost of power generation from wind in the world, like 1.5 cents. And those countries are moving really fast, and now they are after nuclear. So I think those changes that people are not noticing in the oil-producing countries deserve a lot of attention, because the implications are huge. Because all we are saying here is we are going to have more oil and gas without spending a penny on upstream. The other point here is, I think we covered this in the previous interview, that as you know, Saudi Arabia was going to increase production capacity by 1 million barrels a day to 13 million, and then they retracted that a few months ago. And people took that as bullish. No, it's not. It's not bullish at all. And the reason why, because they found Al-Jafura field. Al-Jafura field is one of the largest shale reserves or tight gas reserves in the world. And when you go to tight reserves, you get a lot of NGLs. And it turned out that they can give, instead of spending a lot of money on getting the oil, the 1 million barrels from offshore fields, all they get to do is just go for the gas, and they get most of it anyway as NGLs.
Anas, the OPEC Plus meeting is coming up June 1st. What is that going to mean? What decisions will be made there, and what is the impact on the market?
A couple of things here, Eric. The first one is, in the latest report by OPEC, the latest monthly report, there was a major development. And it was the first report ever that incorporated OPEC Plus into OPEC numbers, which means that it means the gradual transition from OPEC to OPEC Plus. So if you look at the tables, before we used to have only OPEC. Now the tables are OPEC Plus. So this is a very important development. And I'm going to make a wild guess here on your show, and probably remember this a couple of years from now, or probably a few years from now. I seriously think that the name OPEC will vanish completely over time. And they want to get rid of the name, and it will disappear from history. And the reason why, because in the latest report, they never mentioned OPEC Plus. And instead of OPEC Plus, they use DOC countries. DOC stands for Declaration of Cooperation, which is the agreement that been signed by OPEC and non-OPEC, including Russia, in 2016. So now we are moving from OPEC to something called DOC. So when we say DOC countries, that means the total number of countries, which is about 22 countries right now in that group. So this is a significant development. Now, when it comes to the meeting on June 1st, this could be a historic meeting for the oil market. And here is why. People are saying, well, will OPEC increase production, which means that they will reduce the voluntary cuts, because the voluntary cuts agreement ends at the end of June. Well, voluntary agreements are done by countries who are member of OPEC plus, but not OPEC plus, which means that it is not officially, they cannot discuss voluntary agreements in that meeting. Officially, they cannot. So this is not an issue of this meeting, but countries independently can come out after the meeting and declare that their plans independent of each other. So you will see those countries that cooperated on voluntary cuts coming out on their own, and they will say, I want to extend, for example, my voluntary cuts until September or December, because we are expecting that based on the current situation, based on the relatively weak demand growth, based on inventories, that there is no reason for them to increase production. And therefore, they will end up extending those cuts, but it's not in this meeting. This meeting is historic for the following reason. A year ago, they agreed that they will meet on June 1st to hear from three independent companies. These are monitoring companies, and all of them are Western companies. What are the capacities and the capabilities of each OPEC member to reassign the quota? Because there are some countries that are really angry, saying, look, we increased our capacity, but we are still stuck with the old agreement. And now I want to increase my production because my capacity increased. Iraq is one of them, the UAE is another. So they'll bring in three companies. Those companies are going to tell them what their views about the capacity of each country. And then they are going to redivide the quota. So that's the significance. And that's going to be for 2025. It has nothing to do with 2024. So when you asked me earlier about my expectations for 25, and I mentioned the difficulties on the demand side, now we have other difficulties on the supply side because we don't know what will OPEC do, or OPEC plus, or the countries with the Declaration of Cooperation, the DOC, will do in 2025. So that's why 2025 is very difficult to forecast right now. So that meeting, we expect them to renegotiate in a sense, or based on it, they will renegotiate the quota for 2025. And then, not related to the meeting, we will hear individually from countries on whether they will extend their voluntary cuts to September or to December. A final comment here is the Iraqis are overproducing, and whatever they say has nothing to do with reality. They say, oh, they are committed, but they will overproduce anyway. And by the way, the news that Bloomberg published and some other organizations later, that the Iraqi oil minister said that they will not extend production cuts when they end, that was fake news. And to the extent it's fake news, because he was answering question about deepening the cuts. And he said, no, we will not deepen the cuts. For some reason, Bloomberg thought he was talking about the extension of the cuts. So the extension is one thing, deepening the cuts is another. And I would like to end with this because I'm still angry at it. One oil analyst insisted that he did say that they will not extend the voluntary cuts. And I asked him, did you hear the question as being asked in English? And he said, yes, I watched the whole interview and the whole press conference. I said, again, did you hear the question as being mentioned in English? And he said, yes. And he was lying because it was in Arabic.
Anas, final question. You and I have been talking for several years now about an upcoming event, which is super, super bullish for the oil market as we get to essentially the lack of investment finally catching up with us. And you and I have agreed in the past, okay, that's coming, but not yet. And you've always been very careful to say, yeah, that's coming someday in the next few years, but not yet. It isn't time for that yet. How far away from that are we now, and what would it take to turn you outright bullish on the market? Not the qualified where you've been for the last year saying, well, it kind of depends, but just outright bullish. What does it take to get from here to there?
First of all, for the countries within OPEC Plus that cut voluntary, they had voluntary cuts, they will cut only under two related conditions. They will not increase production unless they see a meaningful increase in demand and meaningful decline in inventories. They will not increase production just because of increase in prices because of geopolitical events. So let's be clear on this point. The second point here is we've seen a strong reaction from the investment community. So if we see a strong demand, we will see a strong reaction from the investment side. This is not really, the investment issue is not the big issue anymore because we are seeing kind of like strong reaction, strong positive reaction in terms of investment. The issue is going to be the failure of the green policies, the failure of climate change policies that lead by default to the immediate increase in demand for oil, gas, and coal that is not counted anywhere, and therefore there is no investment to cover it. So what I'm saying here is, as long as we can foresee clearly the increase in prices and the shortages, investment will catch up. But our problem right now is this failure, and that's why the International Energy Agency and the politicians, especially in the Biden administration and the Europeans, are doing a disservice to their countries when they exaggerate the impact of these policies on oil demand, when they exaggerate the impact of electric vehicles on oil demand. They are doing disservice to themselves first, because we are seeing right now, despite all the penetration in electric vehicles, we are seeing this increase in oil demand anyway, and we are going to break record after record. And those guys who are exaggerating the impact of the climate change policies should stop for their own sake before the others. This is just going to lead to crisis. So the issue for me to be bullish is this. We will see those policies collapse, or some of them. That will lead to sudden increase in demand for oil, gas, and coal. We are going to consume all the spare capacity that we have in OPEC members. So the capacity will shrink significantly. We will see reaction from investment. So investment is going to increase, but none of that is going to be enough. And that's where this crisis that we've been talking about is going to happen.
And how far out do you think that is at this point, or as best as you can guess?
The problem we are having right now is, and please give me 2 minutes because I need to explain this point. It is kind of a very important point, and it needs to get its attention.
Take as long as you need.
Thank you. If you look at Europe and the United States and the industrial countries around the world, when they have a recession or slow economic growth, the share of renewable energy increases naturally. Why? Because the sun is going to rise, as we said in the previous show. The sun is going to rise no matter what. Whether you have recession or not, the sun is going to rise. Wind is going to blow, whether you have recession or not. But if you have recession or slow economic growth, what you can control is the amount of gas, coal, and oil that's coming to the system. As a manager of utilities, you can control that, but you cannot control the sun and the wind. So naturally, when you have a recession, the share of those is going to increase. The problem is some people are extrapolating based on what we've seen in the last 2 years. And that's a big mistake, because once we have strong economic growth, the sun is going to rise again, and the wind is going to blow, but they cannot bring more generation. So what managers will do, they will resort to oil, gas, and coal to cover the difference. And therefore, all the trends are going to be, or are going to change completely. So this idea of where the extrapolation is starting is really a big issue here, because Europe is suffering from a recession or slow economic growth. And therefore, you cannot take that and say, oh, look at the future. We are going to have more renewables and the demand for fossil fuel is going to decline as a result. That's nonsense. Once we have strong economic growth, we are going to go back and to fossil fuel, and everything is going to be reversed. And CO2 emissions are not going to continue declining, they will increase. So this is really a major point that everyone has to pay attention to, that the extrapolation from periods of recessions and slow economic growth are not the right way of looking at the futures of energy market.
Well, Anas, I can't thank you enough for another terrific interview. Before I let you go, though, please tell our listeners a little bit more about what you do at Energy Outlook Advisors. I know your Substack has gotten a huge amount of attention, and post-pandemic, you're back on the public speaking circuit. So for people who are interested either in booking you as a keynote speaker or following your work on the Substack blog or elsewhere, how can people follow your work?
Well, generally speaking, we'll do advising for companies, financial institutions, and governments, that in general. We also produce 2 Substacks for individuals and for institutions. The easiest way for people to follow my work and to get the links for the Substacks, etc., or for the speaking engagement is to follow me on Twitter at Anas Alhajji, which is my first name, my last name, ANASALHAJJI. And for those who follow me on Twitter, I would like to emphasize again, please, I do post a lot of things in Arabic that are not posted anywhere in the world. There is a lot of information in the Arabic language, and Twitter has a function, a translate function, below the tweet on the left. So don't get discouraged when you see something you don't recognize in terms of language. Just click that translate button, and it will switch to the language you are using, and you will see that some of the information are not available anywhere else except in the Arabic language.
And again, that's Anas Alhajji at ANASALHAJJI on X or Twitter. Patrick Serezna, Nick Galarnik, and I will be back as MacroVoices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Serezna.
Eric, it was great to have Anas back on the show. Now, joining us again, the post-game segment is Nick Galarnik. Now, let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Anas's picture saying, looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory.
EIA printed a build of 1.8 million barrels of crude oil. Cushing, Oklahoma posted a build of 1.3 million barrels. The drawdown on the board this week was gasoline, drawing down 945,000 barrels. Distillates building 379,000 barrels. U.S. production held unchanged at 13.1 million barrels. That's quite a few weeks in a row with no change. Makes you wonder if they're really updating the data. The continuing weakness that we're seeing is no great surprise given geopolitics settling down at least somewhat and still plenty of spare capacity in OPEC. So far, the market is not interpreting the Iranian helicopter crash as an assassination event. Now, evidence of foul play, particularly by a state actor, could change this picture in an instant. But unless and until such evidence emerges, the market is quiet and time spreads are still retreating, which further supports a flat to down market outlook, barring a geopolitical event, which seems entirely plausible here.
Now, there's no denying that we've been in almost a 2-month downtrend in crude oil, including the last month we've spent below the 50-day moving average. But this has still been more or less a 50% retracement of the first quarter of the year rally. And overall, I still think that there's every opportunity for this to find some reason to bullishly break out. But I think at this stage, it becomes increasingly simple. The highs of May all come along that $80 level where the 50-day moving averages. And so when you draw a descending trend line along all the highs from April and May, you can more or less simply look for some breakout on the upside to signal that a potential new move is underway. And until then, just assume that this correction and grind will continue at least on the very short term. Now, let's move on to equities. Nick, I want to get you involved in this conversation. What are you watching here on the S&P 500?
Yeah, Patrick. So right now, spot price on SPX is approximately 53.10. We have an implied move for the June 21st monthly OPEX of plus minus 110 points, which gives us an upper implied move of 54.20, which is a number that Elon probably likes a lot, and a lower implied move of 5,200. Right now, we have no key resistance as we're at all-time highs, and key support is at 52.50. Right now, I'm inclined to think that we see perhaps another move higher as NVIDIA just blew it out of the water. I think that we're going to see most tech names hit new highs as well. And I think that 54.50 area would make a lot of sense in the short term.
You know, it's interesting you talking about those levels because right along this 5,400 to 5,450 area is my upper resistance levels for the S&P as well. And it's interesting because the relative strength in the NASDAQ is there. And so a move on the NASDAQ is measuring all the way to 19,000 to 19,500 on the NASDAQ 100. And so with the S&P 500, that should line up with it testing that resistance level just about this 5,400 area above. That'll be a real tell as to whether or not that's where the market at least finds overhead resistance. I don't want to already be calling an immediate bear decline, rather simply the exhaustion points for the advances where things could pause and consolidate. And so definitely a bit of a mature rally that is certainly got a little bit more to go. We'll see whether or not these upper targets get hit. Let's move on to the NASDAQ, particularly the QQQ. What are the support resistance levels you're looking at there?
Right now, spot price on Qs is approximately 460, and we have an implied move for the June 21st monthly OPEX of plus minus 11 points. Therefore, the upper implied move is to 471, and lower implied move is down to 449. Right now, we have no key resistance as we're at all-time highs, and key support is right around 445. As I mentioned on SPX, I do think we're going to see further upside on Qs as we're seeing a lot of strength in tech names like Apple, Google, and NVIDIA right now.
You know, it's interesting because what we are seeing is a divergence in breadth. Again, we're back in a scenario where the mega caps are leading the way, the breadth is narrowing, and you're seeing, for instance, the small cap simply not participating. Like, as an example, you know, the NASDAQ's up 1.25%, and then Russell today is up 50 basis points. And so you have a scenario where it continues to lag and has not made those higher highs. So definitely you're right. The NASDAQ has been the leadership. It continues to be that way. And with this move, there's certainly upside for a few more pushes to as all of these things are gaining some short-term traction. What will be really interesting is to see where the exhaustion point of this advances. It's already been 3+ weeks of sustained up price action. At some point, corrective patterns do kick in. There's no sign of it yet, though, and NVIDIA just, I think, added a little fuel to the fire. Nick, though, I wanted to move on and talk about the volatility index. We got down to the 11 handle on the VIX. I mean, right now, being long gamma is and hasn't been cheaper all year. In fact, it's at multi-year lows on the VIX. You have to go all the way back to 2020. First of all, what are the ranges implied, and what are you thinking here?
So right now with the VIX at about an 11 handle or so, we can expect to see roughly 0.7% top to bottom moves intraday on SPX. Right now, insurance is very, very cheap. And given that we see historically on even the strongest up years, typically 1 to 2 pullbacks in the range of 5 to 10%, we already had one down of over 5% recently. I expect another one to occur prior to the election, which means that we have basically June, July, August, September, October, so 5 months prior to that, in which I believe we'll see at some point a correction again of around 5 to 10%. So buying insurance now makes a fair bit of sense given how cheap it is. The question is are you buying insurance now, where we're at 53.20 on SPX, or when we're at, 5,500, for example, in which case your insurance may be far out of the money to be kind of useless overall. I think that, perhaps buying some insurance around September OPEX would make some sense, and using spreads to mitigate overall outlay would make a lot of sense as well, assuming you have a larger portfolio that's exposed to SPX and NASDAQ as well.
On pages 7 and 8, I have 6 month and 1 year volatility. And this is what I actually wanted to dive a little bit into the topic you just mentioned here. Obviously, buying some short-term hedges hasn't been cheaper, but arguably it might be the right price for volatility going into the summer. Maybe the market staying up here and staying in a very tight range into June could be just a summer doldrums. But what I find really fascinating is how 6 month and 1 year volatility is also approaching 5-year lows. Actually, it is making 5-year lows, and we have to go all the way back to like 2018 and 19 to find levels where long-term volatility has been this cheap. And what I find really interesting about that, Nick, is the fact that the 6 month vol is already overlapping the elections, and including the very likely the first rate cuts from the Fed. And so when you're looking at 6 month and 1 year volatility being this cheap with so much future event risk, I think that focusing on short-term volatility is the wrong thing. I think that it's the longer-term volatility that might actually be mispriced. And I think that focusing on some of these longer-dated options may make a lot of sense here.
Yeah, Patrick. I mean, thinking past the election right now, if you look at how cheap insurance is, using, for example, put ratio spreads or put butterfly spreads or even broken butterfly spreads, for example, out of the money and very, very wide, you can get very, very cheap insurance on theses such as, for example, a 20% pullback in the overall market. And this doesn't really present itself very often in terms of an opportunity because typically insurance is very expensive. So moving on to page 9, we have the US dollar index.
Yeah, I wanted to just make one quick comment. The dollar has been also correcting very much like it almost looks like a crude oil chart. And it's been correcting over the last 2 months. But overall, it still remains just a retracement of its prior rise. And with the US dollar yen once again starting to crawl higher, it'll be all eyes will be on that euro, whether or not it breaks below the 108 in the coming weeks. I'll be watching to see whether or not this starts to regain some strength. I mean, it's been a very weak rally so far, so nothing to call as a new breakout. But the supports, at least initially, are holding. So it'll be interesting to see whether the US dollar bulls show up.
Moving on to page 10, we have that gold futures chart. Eric, what are your thoughts here?
This looks to me like a textbook bull market that just retested its all-time high, with the slow stochastics already signaling a strong overbought condition. Wednesday's pullback came as no surprise, and it doesn't concern me in the slightest. This market is getting ready to break to a new higher all-time high, or at least that's the way it looks to me. It needs to first shake out the weak hands who bought the top at 24.50. It's just a question of how far down we have to go in order to accomplish that. Considering the overbought slow stochastics, we could see a deeper correction over the next several days, but I'm confident that this bull market still has plenty of legs and will continue as soon as the market catches its breath.
Eric, I love pullbacks like this. The recent retracement is typically now the type of a pullback that has been over the last 3-4 months always bought on dip. And so with this kind of 2-day pullback, this will be a true test to see whether or not the bulls are still in business and whether or not dips are being bought. Really, as so long as this maintains at or above 23.50, I'll view this as a shallow correction correction and be looking for continuation patterns to the upside. It would the most disappointing thing that could happen here for the bulls is that all rallies start failing and there's no follow through or momentum, and it gets very toppy. But it could take weeks of more technical information to see whether or not something more bearish is underway. I'm assuming here that it's a buy on dip. I wanted to move on though to page 11 where we have the copper chart, and copper has gone outright parabolic in the month of April and May, and the sentiment couldn't be more bullish in this space. We finally now have seen the first pause and retracement of this rally with about a 40-cent pullback off the highs. Usually the first pullbacks like this are usually bought on dip. So I think that with this type of a pullback here on copper, in the next 25 cents, I'll be watching to see whether the bulls can dig in, hold the line, and head that right back to the highs. Where I would become more concerned about this trend is if we see failed rallies and the buy on dip traders don't show up. But again, very similar to gold, you want to assume on the first go that buy on dip traders will be there. And so we'll be watching here in the next 20-25 cents on the downside.
Now on page 12, we have that uranium chart. Eric, what are your thoughts here?
I'm convinced the market has begun a breakout that will begin a big leg higher. As of Wednesday afternoon, we're pulling back to retest the breakout zone, which is a textbook pattern in technical analysis. Assuming that breakout level holds as support, we should see this market move much higher in coming weeks.
Yeah, there's a lot of stories and headlines around uranium, and certainly uranium stocks are actually performing better than uranium itself. But spot prices of uranium continue to actually be pinned. They've been in a very tight range around the $90 handle. For all the stories around uranium, uranium spot prices have really been in a tight range, and we haven't seen uranium as a commodity really start getting underway. What we do see is a momentum in uranium stocks as they continue to bull ahead, but we'll be watching whether or not some uranium follow through occurs. The Sprott Physical Uranium Trust has numerous times tried to break out, but the spot prices of uranium simply are not confirming. So we're in a tight range, and we're going to be looking to see whether or not they can finally see some bullish follow through in the coming period. The final thing I wanted to just touch on is 10-year Treasury bond yields on page 13. And the one thing that I wanted to simply point out here, we went through a period where there was a reflationary cycle where numbers were coming in hot, and that caused yields to press higher. What we are seeing here is finally some slowing in the progression in these inflation numbers, and the yields now coming off those highs. I'm curious whether or not that 470 level on the 10-year will prove to be the high of the year. Now, it's very early to make that kind of a call, but what we're watching is whether or not the yields have any more pushes to the upside, or whether they start to fail and consolidate lower. We're pretty much pivoting right on the 50-day moving average here, which is kind of just showing the fact that the trend that's been working higher on yields all year has really mean reverted, and this is going to be a key pivot area to watch in the coming days and weeks.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview and the chart book, which is discussed here in the postgame, including a number of links to articles that we found interesting. So you're going to find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter @EricSTownsend. That is Eric spelled with a K, and follow Patrick @PatrickSeresna. On behalf of Eric Townsend, Patrick Seresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the Internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.